This lecture will cover two key topics: retirement plans and annuities. This lecture applies primarily to the Series 6, the Series 7, the Series 24, the Series 10, and the Series 65 and 66 examinations. As it relates to retirement plans on the exam, there are all sorts of rules regarding the time limit to contribute, the deadline to contribute, the acceptable contributions, the fact that you can start to take money out at 59.5, you have to take money out at 70.5. I'm not going to focus as much on those details in this lecture, because those are largely memorization issues. Where students tend to have difficulties with retirement plans is remembering which plans are pre-tax plans, also called qualified plans, that's a term I'm going to use here in this lecture, and which plans are after-tax plans, also called non-qualified plans. So some of these plans are pre-tax, some of these plans are after-tax. So, starting with corporate retirement plans. A corporate retirement plan can be qualified. What does it mean as far as we're concerned for the test? What does it mean for a plan to be qualified? Qualified means pre-tax contributions, also called tax-deductible contributions. They grow tax deferred, which means the interest and savings, the interest and gains are not taxed each year. And distributions are fully taxed as ordinary income. So pre-tax contributions, which grow tax deferred, and distributions are fully taxed as ordinary income. Fully taxed means when you take money out of the plan, every dime is taxed. Every dollar that you take out is taxed. In order to be qualified, the plan must meet Erisa Guidelines. Okay. Erisa is a set of federal retirement plan guidelines. Among other things, the plan must be non-discriminatory, so it's got to be offered to everybody at a firm who satisfies certain requirements. And it's got to have a vesting schedule. That vesting schedule states how much an individual gets to keep if they leave the firm. Non-qualified plans, as far as we're concerned for the text, are after-tax contributions. The money goes in after tax. So when you take money out, how much of it is taxed? Only the growth. Within qualified plans, there are two types. You have a defined benefit plan and a defined contribution plan. An example of a defined benefit plan is a pension plan. In a defined benefit plan, the retirement income is predetermined. In a defined benefit plan, the retirement income is predetermined. It's based on the employee's age, position, and tenure, T-E-N-U-R-E. What does that mean? Tenure means how long they've been with the firm. It's based on their age, position, and tenure with the firm. In a defined contribution plan, on the other hand, the burden is on the employee to make their own contributions. Examples include a 401k, a profit sharing, an employee stock ownership plan, a SEP IRA, and a KEO plan. KEO is for self-employed persons. And again, I'm not going to go through the specific details of these because that's not what this lecture is about. This lecture is about knowing that when they refer to a KEO plan, you want to visualize it right here on the chart, which means you know it's a defined contribution plan and you know that all defined contribution plans are qualified plans. The key thing here is memorizing this chart so when you get to the test, you'll be able to visualize where everything falls. Then you have non-qualified plans, which include deferred comp and payroll deductions. Okay, you don't have to know a whole lot about these in detail, but suffice to say they can be discriminatory in nature, so they do not need to be offered to everybody at the firm. Okay. And they are generally going to be after-tax contributions. They're generally after-tax contributions. So again, if you can memorize this chart, That should put you in a good spot for the test, plus the next few charts I'm going to discuss. Now, IRAs, just like corporate plans, can also be qualified or pre-tax, or non-qualified, which means after tax. What makes an IRA pre-tax? Who can have a pre-tax IRA? Individuals who are ineligible for a qualified corporate plan. So if you work for a company that does not offer you a 401k, depending on your income, you can potentially have a pre-tax IRA. So somebody who works for a company that does not offer them a qualified plan, whether or not they use it doesn't matter. It's if it's offered or not. If you work for a company that does not offer a 401k, you can potentially have a pre-tax IRA. If you do work for a company that offers you a 401k, you can still have an IRA. It's just going to be after tax. Contributions will be made with after-tax dollars. Now you might ask, well, why would anybody bother then? Because the money still grows tax-deferred. Even if it's after tax, the money grows tax-deferred. So all the gains and income and whatnot is not taxed all the way until the end. Variable annuities can also be pre-tax or post-tax. Who gets a qualified or pre-tax variable annuity? A public sector employee. So somebody who works for a public school or a nonprofit. That's called a 403B plan. It's called a 403B. Okay, pre-tax annuity is called a 403B plan. It's like a cousin of the 401k. Anybody else can also have a variable annuity. It's just going to be post-tax. It'll be after tax. So again, the combination of these charts will hopefully help you remember the tax consequences for various types of retirement vehicles on the test. There are three types of plans that offer after-tax contributions with tax-free distributions. So it's after tax going in. When you take the money out, you don't pay a dime of tax. Those include Roth IRAs, Coverdell educational savings accounts, and Section 529 college savings plans. These are all after-tax dollars going in, but tax-free coming out, assuming you meet distribution criteria, such as how long the money's in the account and things of that sort. We're not going to go into those details here, but these plans are after-tax going in, tax-free coming out.